Hi everyone, this is Meherban Faroogh from the Thousand Pip Club. Welcome, Happy New Year. This is our first class of the season, 2012. Today is January 4th. What I thought I'd do today is cover a little bit of the sovereign debt crisis. I've talked about this a little bit in the past, and we have to kind of keep bringing this up time and again because it just keeps getting worse. I have a sense from my sharing this with some of the other people is at times people don't really have a good grip on what the heck it is. Why is it so important? How deep the rabbit hole goes, so on and so forth. So I'll try and share some light on that today. And again, this kind of ties in with the big picture thinking we talk about, big picture fundamentals, whatnot. This ties with, for instance, if you manage to get into a good position on one of the risk currencies like the Euro USD or Aussie USD or Kiwi USD going short, and you start seeing things happen in front of you, like the bond yields on Italy keeps going up above 7%, and stuff like that. Credit rating downgrades, Germany, France, whatnot, if and when it happens, if it happens at all. And if you're in a position short, those are the times where you want to hold on to your positions as best as you can. Now, that being said, if you're up 800, 900,000 pips, it's not wise to keep your entry at what you call not book any profits or to keep your stop loss at the entry price. You gradually keep moving your stop loss, but keep a safe distance, and that's the whole point, keep a safe distance to ride out as best as you can. So once again, knowledge like this is critical to maximize your pips, number one. So it has to do a lot with trade management. And the other part is also a little bit of risk management and being on the right side of the trend. So this layers over your technical analysis. It just helps you be in the right direction with the trend and whatnot. Now, before I get into the presentation today on the sovereign debt crisis, I'd like to share a little bit of, so Jeff and Demi and myself and Chris decided to give a little bit of a New Year special, which is, let me just click. So if you go on our 1000 Pip Club site, 1000pipclub.com, up top you will see this New Year special, and I understand that FX Street will very shortly put this up on their site as well. So you can go from FX Street, you can go from our site, same thing. When you click on that link on the home page, this will open up. I'm not sure if Mark is here today, but Mark is one of our new members on 1000 Pip Club. He's a member from FX Street as well as the newest process. We're offering 33% discount up to February 3rd, 2012. It's a limited time offer. $1,000 off from our regular price of $29.95. If you scroll over this, you'll see what you'll get. You can also find this on FX Street. Now, one thing, and I'm not sure on the details because I don't figure this out with Jeff and Demi and Chris, but what we may do in the next few days is what you call, we'll have an open house. We'll have probably a 1 hour open house of our site. So typically, you would log in. You'll have to be a paid member to log into members area. But in that 1 hour, when you decide to put it up, you can actually go into our site and have full access to our site. So you could go into syllabus, flowchart, and the stuff we talk about in that 1 hour. You can kind of just have a good feel of how detailed we are, how comprehensive this entire course is, how well it's organized, so on and so forth. You can go into chart studies and look at some of the chart studies we've done, so on and so forth. So it will just give you a good feel in order to help you decide if this is something that fits your understanding, that fits your needs as to where you are, so on and so forth. So I'm just clicking on a few examples here that you can see. I understand a little bit of a delay between what I'm seeing at my end and the hotcom room, so there might be 5-10 seconds delay, but essentially you can get access to all this when we open this up shortly something we had to figure out. So anyways, if you want to check it out, go and check it out, 1000 Pip Club. This is a limited time offer for 33% off. Okay, that being said, let me get started. So Dimay, you'll keep an eye, Dimay will be keeping an eye on Forex Street, and I'm trying to figure out where it is, which one of these tabs it is, on forexstreet.net. Okay, bear with me. There it is. So for those of you who are new, there are two sites. There's fxstreet.com. That's the main FX Street site, and there's also forexstreet.net. This is essentially the section where we have groups. I've opened up a new group, 1000 Pip Club, live currency analysis classes, specifically for the purpose of our Wednesday class. And the whole idea here is, if you've been attending this enough, you should know this by now. The whole idea here is for the students to step up, stretch themselves a little bit. And especially if you're, I keep saying, especially if you're new to a little bit intermediate, you'll find this tremendously helpful over a series of weeks if you step up. There's a trade plan format that I've already submitted. Go into trade plans folder here and just click on this link. A template will open up. And essentially, I'd like you to pick up any one of the 28 pairs, whether it's a US major, a yen cross, an exotic, whatnot, and just share your trade plan based on what you see, based on the format we explained in our November 16th class, and put this up on this forum. I'll pick it up on Wednesday. Now, the idea is for you to do this right, you have to make sure this is a little bit current. So our classes on Wednesday are 12 GMT or 7 a.m. Eastern in the morning, Eastern time zone. So try and do this 3, 4, 6 hours before, not like a week before, because otherwise it's not live, it's not current. Initially, I'm just going from my experience and 5, 6 years back and experience of other students that I've taught. Initially, it will take you 3 to 4 hours even to do this right, to submit your first trade plan, and it may not even be complete, and that's fine. And that's really fine because, initially you're learning, right? And that's the whole idea where Demi and myself are there to help you out. But once you take the effort and once I guide you a little bit on what you missed out, whether it's technicals, whether it's fundamentals, whatnot, you'll start improving, right? And then kind of one step after the other, it kind of goes from there. So once again, I request for the students to step up and share the trade plans. Once I'm done with my presentation today, I'd like to, I'll go back on chat room and I'll ask students, those especially who are regulars, what's holding them back? Is it that you don't have the time? Is it that you don't understand some things or something else I can do or explain better in order for you to submit these trade plans? Because that's what these Wednesday classes are for. Okay, that's it. Now let me get started with my presentation for the day. Okay, let me put this down. And okay, so the point I want to make here is, if you keep hearing in the news about the Italian government bonds issue and the fact that in November, I believe, so what I've done here is I picked up this chart from Bloomberg, and you'll see that I think it was November for the first time, or October, I don't recall exactly, but somewhere around October, November, they went above 7%, and kind of hell broke loose, and across the media, you would hear statements that, oh, this can't continue for a long period of time. The fact that Ireland, Greece, and Portugal, they were all forced in requesting for a bailout once their 10-year bond yields climbed above 7%, so on and so forth, blah, blah, blah. The question you have to ask yourself is, why is this important for you to understand? So what's the relationship between the sovereign debt crisis and Italy's 10-year bond yields, and what does this have to do with trading currencies? That's the whole intent of my presentation today. Something to keep an eye on. Some of the facts I'll go through today, most of this you should probably know by now, but if you haven't, and if you haven't kept a trail of list of events, then hopefully this should help you. So as I say up here, size matters, right? So again, it's common knowledge. I just picked up this from Wikipedia. And again, if you Google and go to different sources, some of the numbers might vary, but it will give you a general sense of where Italy stands in context to the other EU nations. Now, keep in mind that EU, which comprises, if I understand correctly, of 27 countries, its GDP is 26% of world's GDP. So 16.2 divided by 62.9. It's about 26% of world's GDP. So it's of course, it's quite significant. The countries I want to focus on today in the presentation are Italy, Spain, and the three, Greece, Portugal, and Ireland, that have already gone for bailout. The point or the case I want to make today is try and understand how much the euro dropped. How much the euro dropped based on Greece's bailout, Portugal's bailout, Ireland's bailout, and what proportion were they of the overall EU GDP, and what's the size of Greece, Portugal, Ireland compared to Italy and Spain, and if Spain goes for a bailout, which seems, well, again, we'll see what happens. And if Spain was to follow, how far can the euro drop? And I keep saying euro, but again, it's Aussie, Kiwi, risk, how far risk off will happen, essentially. So a quick math would tell you that Italy's GDP, 2 trillion. These numbers are in billions, by the way. 2 trillion is 13% of the overall EU's GDP. Spain's 1.4 trillion is 9% of EU's GDP. Greece, which was really the main cause, followed by Portugal and Ireland, their combined GDP of 738 billion is only 5%. I'll repeat this. This is the point I want you to understand. Greece, Portugal, and Ireland's combined GDP, 305, 229, and 204, based on 2010, 738 billion is only 5% of the overall $16.2 trillion EU GDP. These three nations combined, 5% is less than half of Italy. Italy is 13%, so it's more than double. Just keep that in mind. Spain is nearly twice of the three combined, Greece, Portugal, and Italy. If I haven't said this loud enough or enough, then let me just put some boxes around it to make it further clear. Okay, hence my point. So let's go on from here and see how this plays out. So on this, what I've done is last night I picked up the euro chart, and I'll be focusing on three swings. This is a monthly chart, by the way, Euro USD monthly chart, and there are three short cycles on the monthly chart that's happened. So the first one, where it dropped, I believe the top was 60. I think it was 60.37. When it dropped from 60.37 all the way down to 28 something, I recall 28.32 or something. Those four months of red candles, those are really when the subprime crisis kicked off, 2008 subprime crisis kicked off. Okay, so let's get that out of the way. The recent drop in 2011 is a stock market crash, right? And again, you can almost put up the Dow or the S&P in parallel to the Euro USD, and you will see it's almost the same time when the euro started dropping. So let's get these two out of the way. What I want to focus on today in the next few minutes is on this drop from 51.43 to 18.75 on the Euro USD. See what caused this, why, how it played out, and what does the future look like? What does the future look like in context to Italy, and then if Spain was to follow as well? Just let's try and learn, because history has a tendency of kind of repeating itself, right? So again, it's all thanks to Google and a lot of wonderful people who do a lot of hard work. I've just kind of copy pasted that and added a little bit of graphics. So last time I was Googling for the Greece Crisis Timeline, I came across The Guardian, which is a UK newspaper. There's a nice little history timeline, so just kind of grabbed it from there. I'll quickly go through the timeline. So as we know, in January 2001, Greece joins the euro. By November 2004, Greece admits fudging the euro entry. So if you recall, one of the criteria was that the deficit should never have been below 3% since 1999, and they had fudged those numbers. So they admitted that. That's fine. Let's move on. In March 2005, austerity measures start coming in, tax hikes, whatnot, increased VAT. October 2009, George Paparando becomes a PM, and basically his government says we should expect deficit 2009 to be 6% of GDP. So still there's no massive shorting, but just around the next month, now if you go down to your daily charts, this is a monthly chart. If you go down to your daily charts, you'll see November 25th, 2009, essentially is when euro hits 51.43. That's the top here, right there, that candle, top there. 5 days later, the debt fears mount, where Paparando admits that economy is an intensive care. I apologize if my pronunciation is not correct of some of these names. I hope you'll excuse me for that. But debt fears mount, and he openly admits that the economy is in intensive care. Guess what happens? It's already hit its all-time high. Right after the Prime Minister, the newly appointed Prime Minister of Greece, openly admits, 2 or 3 days later, it does a double top almost. It hits 51.40. So this you'll see on a daily chart once again. It hits 51.40 and it never looks back. It just drops. Going forward, December 8, 2009, Fitch downgrades. So you see the number of days. You see how close these events are timed. So when kind of hell breaks loose, it doesn't take too long. So December 8, Fitch starts downgrading the Greece rating from A- to BBB+. Now, I'm hoping most of you already know this, but for those who don't, rating affects your borrowing cost. Your risk, international bond traders or whatever investors, they perceive risk to go up automatically as soon as the rating companies like Fitch, S&P downgrade your long-term sovereign debt rating. So the cost of borrowing goes up December 8th. By December 14th, the Prime Minister unveils radical reforms, deficit cuts, blah, blah, blah. December 17th, strike hits Greece. As debt crisis grows and S&P follows Fitch rating cuts. So once again, can these events of the history play out with Italy? God forbid, in the future, 2012. We'll see. I'll show you some stats. We hope they don't play out. But if some of these events seem familiar around Italy, then you should start considering to take this pair short, in my opinion. Euro USD short, Aussie USD short, Kiwi USD short, risk essentially starts going off. So once again, just pointing out, that's 51.40 right there. Okay. Moving along. So February 2nd, the Prime Minister makes a TV appeal over financial crisis. February 26th, Goldman Sachs faces the Fed inquiry over Greece crisis, using derivatives to disguise how Greece was borrowing. So that's amazing. So on and so forth. Let's move on to March 4th. Greece breathes a sigh of relief as 10-year bond sales proves popular. Now, there's a reason I highlighted this in blue. And this is what I talk about. If you follow the news, when you see 7 days or 10 days or 15 days of bad news or bad sentiment, there'll be those 3 or 4 or 5 days of good news. Whether it's good news coming off events like Angela Merkel making a positive statement, or Nicolas Sarkozy making a positive statement, or IMF's president making a statement about supporting Italy or Spain or whatnot, or the bond sales, especially the 10-year bond sales, below 7%, like in current times. If I'm talking about Italy in current times, if it goes down to 6%, then people start taking a sigh of relief. You'll see risk on for the next 2 or 3 days, and that is an opportunity. That is an opportunity. So if overall things haven't really changed, and one issue of a 10-year bond goes like 50 bips below 7% or 6.5%, or if some politician or central banker makes a statement, just a statement without any substance, that's great news, right? That's great noise. That's what you want to follow, especially if it retraces against the popular trend, which in this case happens to be short, and it goes and hits a strong support resistance level, fib level. It extends its average daily range, whatnot. That's an opportunity. That's why you need to understand your fundamentals. My point. So moving along, March 29th, once again, Greece struggles. So once March 4th, they did a good 10-year bond sale. In the next few days, in about 25 days, Greece again struggles on after-week response to bond sales. So it's back to normal, and it keeps going down. I'll quickly move on. April 19th, Greek borrowing reaches record high. So if you were following at that point in time, and I recall distinctly when we were doing 1,000 classes every week, we were kind of following this very closely. Greek versus German bond yields, they reached, I think, the all-time high at 469 pips. I'm not sure if this is all-time high, by the way, but it's also a significant period of time where kind of they freaked out. April 27th, S&P. Now again, S&P takes a lot of things into account. I'm sure they also take into account what the bond traders are telling them, either widening yields or the increasing yields and so on and so forth. They downgrade Greece to junk status, BBB. The stock markets plunge worldwide, and the rest is almost history. EU and IMF talks goes on for a $20 billion package. Greece has finally granted 110 in May. Greek protesters take to the streets, so on and so forth. Markets loses faith. So that's the scandal. The sharp candle is essentially May that comes down, and finally it hits 1875, and I guess the market says, okay, that's enough. Punishment from 5143 to 1875. A lot of it, all of it, if not all of it, a lot of it had to do with Greece. So here's my case. So 1875 was hit when, and I say Greece, Ireland, and Portugal, but I think it was mainly Greece. But even if I include Ireland and Portugal combined, they're only 5% of EU's GDP. So how much do you think the euro can drop? On Italy's debt crisis, considering that Italy is 13% of EU's GDP. So look at the charts. Do you see a trend? Short. This is the subprime crisis. Kind of goes back up along with the, I believe, this candle low. This green candle low was March, if I'm not mistaken, or somewhere around there is March 2009. That's when the stock market started, rallying back up. Then Greece took it back down, 5143 down to 1875, right? And then once again, the cycle followed. One of these candles, I believe this sharp red candle, I think it was Ireland or Portugal, I don't recall which one, but, and likewise, this red candle was one of those countries. Bond ratings went up and, yields went up and so on and so forth. But then again, the stock markets kept going back up. Continued going back up, and throughout this period, from 1875 to whatever the stop is, I think 4,900, close to 5,000, the stock markets went up. There was positive risk sentiment. Risk was on. Risk currencies did well, so on and so forth. Then the markets realized, I'm talking the equity markets realized that, whoops, we've overextended ourselves. The unemployment in the U.S. is still 9%, 9.1%. Nothing much has changed. The housing sector is still doing bad, blah, 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 blah. There's another slide I'll show you from McKinsey. This is very interesting. It talks about bonds and stocks and whatnot, but you'll see that. The euphoria that was caused by just going through a rally, that was probably not warranted. But anyways, the stock market started crashing and in 2011 or came down significantly. And the euro kind of followed. This is where we are. So my thought is unless there's something really concrete, and I know for a fact, I really admire, quite frankly, for what Angela Merkel and Sarkozy and these people are trying to do. It's in a very difficult situation to be in. Same goes for Bernanke. I mean, these are people. These are very intelligent people, and they have a very tough job. I wouldn't want to be in their shoes. I'd rather be a forex trader. But they're trying their best. But there's only so much you can do. Okay, so in my opinion, markets have to correct themselves. They overshot. You can. Now the thing is, again, this is my opinion based on my read. The central bankers, especially Bernanke, who's been a student of the Great Depression, if you follow his speeches, he would just not let the market crash. And if it does, it's going to be really bad. So they will do their utmost best to avoid that. And when they put in stimulus packages or QE3s or prolonged rate decreases, whatnot, you start seeing some green candles form on the Euro USD, Aussie USD, Kiwi USD, just follow the stock market. Stock market starts rallying, but overall, until you see some concrete results from the EU and the IMF to take care of Italy, especially, and time's running short, and that's what I'll show you in the next few slides. Excuse me. Time's running short. The patience will run short. Whether it's the rating agencies, what I'm more concerned about is the bond market than the rating agencies, quite frankly. But once the patience runs out, I would not be surprised, personally, to see a huge drop like this. You see those 6-7 candles, red candles. I would not be surprised to see that. I would not be surprised to see it break 1875. Okay, so time's running short. So the point I'm trying to make here is, once again, if these three countries, or really Greece combined, just kind of cause this huge downtrend, 5143 to 1875, what can potentially happen if Italy was to default? Not really, well, it won't really default, but it'll get a bailout. I don't think they'll default. They'll get a bailout. So once they get a bailout, that's bad news, right? That's really risk off. And again, you also hear about Spain being in the news. I've got some good friends in Spain and Italy, and I really hope this doesn't happen, but as forex traders, we need to be prepared for this. Okay, so that's kind of my case on the Euro USD. Let me move on. So how bad can this get? Once again, what I was looking for in this slide, as I was Googling last night, is something to do with GDP and more about debt. Public debt as a percentage of GDP. So I came across, again, Wikipedia. Thanks to Wikipedia, they've got some wonderful stuff there. And I just borrowed it from there. So what I'm trying to show you here, once again, is that 5143 drop down to 1875. Greece was a primary factor. Greece was only 305 billion GDP. And in terms of the public debt, point taken, they were 142%. They were 142% debt to GDP, very high ratio. Ireland was 96% debt to GDP, and Portugal was 93% debt to GDP. These are three nations that have already taken the bailout. But look at Italy. Italy is 119%. It's at 119% of GDP. That's not something very nice. Before I forget, one more indicator I want to show you was the unemployment. Unemployment in Greece is at 18.3%. And I believe these are the most current numbers. 2011 M9. I think M9 is month 9. So this is based on September. Greece is 18.3. Ireland, Portugal is 14.3, 12.9. Definitely very high. Italy is still okay, I guess. 8.3. US is around 9%. I believe EU is overall at 9%. But this is also a number to watch in Italy, where the unemployment goes. But the most crucial thing, how you say it, you can almost count high-level things on your 5 fingers on one hand. One of them to keep an eye on, in my opinion, are the bond yields on Italy. if the 10-year bond yields go above 7%, you should I can almost guarantee you that day the euro will drop 100, 150 points and may continue to drop over the next 2 or 3, 4, 5 days. So once again, do your homework. I'm just giving a heads up. While you're looking at Italy, it's also important to look at the overall big picture. And I think this was an interesting fact, again, thanks to Bloomberg. So governments of the world's leading economies like Japan, US, Germany, so on and so forth, have more than $7.6 trillion worth of debt maturing this year, with most facing a rise in borrowing costs, like I talk about Italy and so on and so forth. So you can see Italy. Now this is, by the way, billions of US dollars converted, right? So Italy's total debt is $1.9 trillion. Okay. Of this $1.9 trillion, $330 billion is due in 2012. Okay, $330 billion. $330 billion in dollar terms is $428 billion. I know these are a lot of numbers, and you don't need to get lost into this. I thought this was just interesting facts. The point I'm trying to make here is that while EU is in a bad shape, so is US and so is Japan. So, and the reason I pointed out is because, I mean, really, of the 8 major currencies, the top 3 are US dollar, euro, and the yen. Once again, US dollar, euro, and the yen. Anyways, I'll probably go off topic if I go into Federal Reserve printing and stimulus, but let's stick to the point. So 2012 is probably the year of reckoning. A lot can happen this year, given that the European governments, they need to raise 1.1 trillion, so on and so forth. So the point I'd like you to pay attention to is by March of this year, in the first quarter 2012, Europe needs to raise 157 billion euros under these conditions, right? Under conditions where Greece is raising debt at about 7%. Germany is still doing pretty fine. If I read correctly this morning, they raised was it 10-year or 5-year at 1.94%. So Germany is doing fine, but it's more about Greece. It's more about Spain. It's more about other nations, right? Whose debt to GDP is a little screwed up. Italy has to raise 53 billion. So this money, raising it from the public and the banks, in my opinion, is very difficult unless Angela Merkel, unfortunately, calms down and she allows ECB to lend, or EFSF starts stepping up, and a lot of other things have to happen. So, if I recall, January 9th, today's the 4th, right? So in the next 5 days, Merkel and Sarkozy, they're again meeting to discuss stuff, I guess. Something they have to propose by end of March. The only point is, again, depending on what they announce after their meeting on 9th. So keep an eye on the news, see what they announce. If there's a little bit of noise and the Euro USD or the Aussie just spike long for the next 2 or 3 days and hit certain numbers, that could be potentially an opportunity to short it. Okay, if you think that's almost noise and not much concrete data. Okay. I think this is the last slide. So in this last slide, I just wanted to do a quick comparison of 2008 versus what potentially future can behold. Now, keep in mind, of course, what I'm saying is quite pessimistic, right? It's a negative side. It doesn't have to happen that way. I see signs of it happening, but it doesn't have to happen that way. It can be prolonged for a long period of time, not just months. It can be prolonged for 2 or 3 years, and then it might happen. But the point here is the subprime crisis, which was a result of overvalued property prices in the U.S. primarily. So the total home equity in the United States was valued at $13 trillion. Now, I Googled this a lot, and I think that's close to the number that I got, once again, from Wikipedia. But the total home equity at its peak in 2006, before the crash happened in 2008, was valued at $13 trillion, right? and it dropped to 8.8 trillion by mid-2008 and continued dropping. But check this out, and there is almost, it's very difficult to find a number that gives you the overall size, the total size of global debt. That's what I was looking for. The total size of global debt, I mean, it's very difficult to find that. If my numbers are not correct, please let me know. But the thing that I found closest to the truth was this slide from McKinsey's Global Institute Analysis report, and they based it on the BIS and Standard & Poor's and a bunch of other things. But this is interesting. So this is something I would like to quickly go through with you. Keep in mind, this is in trillions of dollars, right? And the point here is that the world's stock of equity and debt. So each of these bars, let's explain. Each of these bars, it comprises of stock market capitalization. So for instance, in 2010, the world's stock of equity and debt, total debt and equity, is $212 trillion. Of that $212 trillion, $54 trillion is stock market. This is worldwide, not just US. 54 trillion is a stock market capitalization. 41 billion is public debt. So I think your sovereign debt falls here. 41 trillion. Financial institution bonds outstanding is 42 trillion. Once again, my understanding is if hell breaks loose, if Italy keeps issuing debt above 7%, and the sovereign debt crisis happens, the sovereign bonds prices fall, I think overall your corporate bonds will also start falling. So it kind of goes with the yield curve pattern, so on and so forth. But once again, there's 42 trillion worth of financial institution bonds outstanding, 10 trillion worth of non-financial corporate, 15 trillion securitized loans outstanding, and 49 trillion worth of non-securitized loans outstanding. I'm pretty sure this also covers your mortgage-backed securities, CDOs, whatnot. So I think all that stuff kind of falls in 49 trillion down here. The point I want to focus on is the following. The whole purpose of this chart is to show you that pre-subprime crisis, which happened in 2008, when the market dropped to 175 from its all-time high back then, $202 trillion. In 2007, its all-time high of the world's stock of equity and debt was $202 trillion. Because of the 2008 subprime crisis, it fell to 175, and you can see the numbers dropped on stock market capitalization from 65 to 34, so on and so forth. But then it steadily rose. If you again remember your charts, if you go back to March 2009, and if memory serves me right, 66.47 or something like that, was the low of Dow. From that point on, it just kept going up, right? And that's the point I want to make here. That if you look at these compound annual rates from 1990 to 2009, once again from 1990 to 2009, on an annualized basis, compounded, stock market capitalization rose 8.1%. So how much is that? That's what, 19 years, 19, 20 years roughly. Over 19 years, on an annual compound basis, stock market grew 8.1%. After the subprime crisis, 2008-2009, since the stock market took off March of 2009, even though your unemployment in the US was above 9% and worldwide unemployment didn't change significantly, even though your real estate prices were subdued and or if not going further down, your stock market capitalization went up just between 2009 to 2010, went up 11.8%. That's huge. And your public debt securities outstanding went up once again from 1990 to 2009. Annually, public debt securities went up 7.8. just between 2009, 2010, right out of subprime crisis, it went up 11.9%. Huge. Is that a bubble? I think so. So what's happening? So how is that important in terms of currencies? Well, bubbles crash, right? Home sales crash, property prices crashed. And the point I'm trying to make here is, once again, if I go back, I'll go back to my chart in a second, but the subprime crisis was caused by in 2008, and the value of the property at that point in the US was 13 trillion only. The sovereign debt crisis, if I just looked at 41 trillion also, that's huge compared to 13 trillion. Keep that in mind. And if I go back to my presentation here, this is the drop I'm talking about. So if it was to drop, if a Euro USD was to drop as an example, how far can it go? 1875 below whatnot. So now once again, going short at certain price points, of course, and the factors falling into place. But if you manage to get in short and you follow the news and you see the news being negative or being risk on, it'd be wise to hold on to your position, some of your position, not all of your position. You should definitely take profits at 75 pips, 50 pips, 100 pips, whatnot, but hold on to that last 1/3 or 50% or 25, whatever you feel comfortable with, and try it in demo. Try it in demo, see how it works out. That's what trade management is all about. Okay, with that, I'm done with my presentation. Let's see how I'm doing. So, how's that doing? So, any comments, any thoughts, any questions? I'll open it up. Dimi, do we have any plans in yet on the forexstreet.net site? What's your view on gold? Yeah, Dimi wrote it out. So, Chelsea, I'm glad you asked that. I'm glad you asked that. That's all I'll say. As Dimi said, I think what I'll do next week is I'll share my thoughts on gold. If you want, I can share it now as well. If we have 15-20 minutes, I can do that. But I'll do it at the end if I have some time. This is very interesting. I think the and again, in my opinion, please you should do your own homework. But I think one of the best opportunities right now, or between now and the next 3 months, in my opinion, 3-4 months, is to buy silver. I think silver, as you know, probably is more volatile than gold in terms of the bang for your buck. Silver probably would do better. But on a serious note, I think silver, definitely gold as well. But I'll share some stuff with you that'll open up your eyes if you haven't thought through this before. Buying silver around 21.36 would make a lot of sense. And if it further continues to go down, buying the dips. And I'm talking about your retirement funds, by the way. So I'm not concerned about volatility. I would buy it and kind of hold on to it. Okay, so if you don't have any presentations, any trade plans, here's what I like to do, guys. We have another few minutes, and here's what I like to do. And I'd really like you all to participate. If memory serves me right, I believe this is our 10th class, and I hope this is being recorded at INDA because for those who could not attend today, I'd like them to hear it out and take some action. So this is our 10th class. If memory serves me right, November 16th, I'm sure 16th or November 23rd, one of those two classes, is when I shared or explained how you could write out your currency trade plans. The whole intent of us doing these Wednesday classes is to help you guys especially those of you who are beginners to intermediate students, to excel. I see it as part of my job, unless somebody tells me otherwise, to give you a gentle push. And as part of that push, I have to keep reminding you all to take the time and submit your trade plans in our weekly class. I totally appreciate that it's not easy. As I've said before, I'll say it again. If I go back 5 years, 6 years when I started it out, and somebody else was doing this for me, and I tried to submit the plans in class, it took me almost 6 months. If I recall correctly, 5 months or 6 months to submit my first trade plan, and that's because nobody ever explained to me how to submit it. I saw people submitting trade plans, and this was another class I'm talking about anyways. So one of the first things I did when I started this was make sure I give you a structure, a format, and we also have, if you visit www.1000, besides, Dime, if you don't mind typing it in, I'll appreciate. Type in the web address of our website. You can go on www.1000pipclub.com and go on free training link. Besides what I've explained on November 16th and November 23rd on FX Street, and it's archived there. You can also go through that free training site. And no, maybe not that one. That's the Hotcom room. I'm talking about 1000pipclub.com, free training site. And there's, I think, over 2 to 3 hours of video, especially the basic trade plan part 1, basic trade plan part 2. Go through it. You should have enough understanding of submit your trade plans. For those of you who do step up next week and going forward and submit the trade plans and continue to do so over the next few weeks, especially if you're new, I almost guarantee you your knowledge, your understanding of Forex will definitely go up. I would not waste this opportunity. Again, we're doing this, I don't know for how long on FX Street. But till we're there, I would suggest you avail this opportunity, make most of it. You will see your knowledge go up. Now, my question to people who are in class is, what's holding you back? What's holding you back? I would appreciate if you guys are candid. So I can understand what else I can do. Do you need more time? Do you need more coaching? Do you want me to do more plans? Because what is it that I can do? And guys, I will not take offense to anything. Feel free to say anything you want. If you think I'm not done enough, if you think I've not said it clearly enough, say it. If you think you need time, just let me know. If you feel intimidated, that's fine. Just let me know. I know, by the way, that public speaking is probably one of the most difficult things. People rather die than speak publicly. The same goes for submitting trade plans. The other thing, if you feel that you submit a wrong trade plan, don't worry about it. I'll tell you, the first year or so, I submitted a lot of wrong trade plans. That's fine. That's how you learn. You make mistakes and you learn. But if you don't make the effort to learn, you won't learn. So you have to make that effort to learn. So what I'm trying to understand here is, and I'm not seeing any responses, not sure if it's a delay on my side or people are just listening to me or what, but can I get a few whys or yeses from people to understand if they'll make an effort next week or the week after? How many of you will at least make a decent effort in the near future to submit a trade plan in class? I just want to know. So if you're willing to make an effort, thanks, Chelsea. I really appreciate that. Thank you. Anybody else? Is there only one person that will make an effort, guys? Come on. And Chelsea, trust me, just try your best. Pick up any pair, Tuesday night or whatnot. Try your best. Just, are you going long? Are you going short? What price point? What's the basis, support, resistance, Fibonacci? And I'll help you out. That's what my role is, right? And what fundamental factors do you think support your trade or can cause a risk against your trade. Those are the kind of things I want to know. Those are things you should know before taking a trade. That's the whole intent of this class. So guys, can I have a few more commitments here? Just one? That's a little disappointing. But anyways, if that's what it is, then that's what it is. We'll start from one. That's fine. Chelsea, is there anything I can do more? I'm not sure if you've been regular, but oh, thanks. Thank you. Yeah, that's what I thought. I haven't seen your name before. So this is the first session. So that's really bold of you, and I really appreciate that. I'm hoping more people will join you. Again, this is very natural. This is normal. Typically, I've had 50, 60 people in class, only 2 or 3 submit their trade plans, so I'm kind of used to this, but I like more people to do this. It really helps. So there's a link from Adinda. My previous webinars are right there on that link. Unless if there's any more questions, I'll be more than happy to stay on for a few more minutes. Otherwise, I'm almost done. Chelsea, I'd really like to thank you once again. And for those of you who are still thinking, please feel free to submit your trade plans next week. Okay, there it is. So 1000 Pip Club. Maud just, hey Maud, good to have you here. Maud just posted this link. From Friday, we'll find $1,000 discount on 1000 Pip Club courses on this page. Hey, glad you can make it. So Maud, I'm trying to push people here to submit their trade plans, okay? And we have one volunteer, Chelsea. I'm hoping more will turn up in the future as people will see Chelsea do this, and others I'm hoping will step up too. Okay? I hope so. All right, guys, I'm done. Chelsea, thanks again for volunteering, and I'm hoping others will volunteer too in the future. Okay, see you next week. Bye now.